Welcome back to the Tesla Daily News Podcast. Today is Monday, January 19th, 2026, and we're tracking a busy set of Tesla headlines that could move sentiment around autonomy, manufacturing leverage, and regulatory risk. In the next few minutes, we'll cover three big themes. 1. Fresh signals on Tesla's next self-driving computer and what that means for the FSD roadmap. 2. New detail on Tesla's humanoid robot rollout inside its factories. And 3. The regulatory and headline risks investors should keep in mind this week. Story 1. Tesla's next self-driving computer is almost done again. Elon Musk says Tesla is almost done with the AI-5 design, which is Tesla's next-generation onboard computer intended to run future versions of full self-driving. Here's the context investors care about. Autonomy is still a key part of Tesla's valuation narrative. If Tesla can scale higher take rates on FSD software and eventually robotaxi-style revenue, the margin profile changes dramatically. But that upside depends on two things: software capability and the hardware platform that can reliably run it at scale. The detail that matters. This almost done update comes about 6 months after Musk previously said the AI-5 design was finished. That kind of timeline slippage is not rare in cutting-edge chip programs, but it does raise two investor questions. First, is Tesla pushing a true architectural jump or iterating under real-world constraints like power draw, memory bandwidth, and supply chain availability? And second, what does that do to deployment timelines for vehicles that will actually ship with AI-5? Impact for the stock. The nearer-term effect is sentiment-driven. Bulls will hear progress and a path to higher autonomy performance per dollar. Bears will hear moving goalposts and worry that autonomy timelines remain elastic. What to watch is not just tweets. Watch for evidence in production planning, supplier chatter, and whether Tesla starts signaling upgrade paths for owners. Takeaway. Treat AI-5 as strategically important, but don't model revenue inflection until Tesla shows a clear shipping timeline and a plan for fleet transition. Story 2. Tesla's Optimus robots are reportedly already at around 1,000 units inside Tesla facilities. The Hook. A report out of Russia's tech press claims Tesla is already operating roughly 1,000 humanoid Optimus robots across its own sites. Context. Optimus is Tesla's second major option value story alongside autonomy. The investment case is that if Tesla can build general-purpose robots at scale, it can both reduce its own factory labor cost and potentially open a new product line with software-like margins over time. The details. The report frames these as third-generation Optimus units deployed internally, doing tasks previously handled by humans. Even if these robots are limited to structured, repetitive jobs, internal deployment is a key milestone. Why? Because the first real value of humanoid robots is not flashy demos, it's consistent uptime, safe operation, and measurable productivity inside a controlled environment. Impact. If the 1,000 figure is directionally accurate, investors should think in terms of manufacturing efficiency and learning curves. Each internal deployment can generate data, reveal failure modes, and accelerate the design for manufacture cycle. That can translate into lower cost per unit and faster iteration. But there's also a risk angle. Tesla's robot effort has had leadership turnover. Another report says a former head of Optimus development, Milan Kovac, has moved into an advisory and director role at Boston Dynamics. Leadership changes don't automatically mean trouble, but they can slow execution or shift priorities, especially when the program is still proving itself. Takeaway. Optimus remains high upside, high uncertainty. The bull case strengthens when Tesla proves repeatable factory productivity gains, not just unit counts. Story 3. Regulators give Tesla more time on the U.S. investigation into full self-driving behavior. The Hook. U.S. regulators granted Tesla a 5-week extension to respond in the federal investigation into allegations that vehicles using what Tesla calls full self-driving have broken traffic laws. Context. Regulatory scrutiny can affect Tesla in 3 ways: direct compliance costs, forced changes to marketing and user interface, and constraints on feature rollout. Autonomy is a product, but it's also a regulated safety domain, and timelines can get set by policymakers as much as by engineering. Details. The investigation was opened after authorities said they had collected dozens of reports involving behavior like running red lights or driving on the wrong side of the road in some situations. The extension itself isn't a penalty, but it keeps the issue alive and can prolong headline risk. Impact. For Tesla, the near-term risk is narrative. Anything that raises uncertainty around FSD rollout can compress the multiple investors are willing to pay for future software earnings. The longer-term risk is if regulators require material changes that reduce convenience, require more driver engagement, or limit where features can be used. Takeaway. If you're trading Tesla around autonomy news, Remember that regulatory cadence can lag product updates and surprise investors even when engineering progress is real. Story 4. Pricing and demand signals. 0% financing is back in the EV market, and Tesla is part of the conversation. The hook. EV media is highlighting a wave of 0% financing offers in January, including Tesla's more affordable configurations of the Model Y. Context. Financing incentives are a demand lever. When rates are high, monthly payment matters more than sticker price. For automakers, that can protect unit volume, but it may pressure margins depending on who is absorbing the cost of the incentive. Details. While the specific deal terms vary by region and credit profile, the bigger point is that EV competition is increasingly being fought through the financing channel, not just MSRP cuts. Impact. If Tesla uses financing support to sustain deliveries, it can stabilize market share and factory utilization, which matters because underutilization hits automotive gross margin hard. But investors should watch whether incentives become structural. If they do, the market may treat Tesla less like a high-margin software optional story and more like a mature auto business. Takeaway. Strong delivery volume is good, but the quality of demand matters. Track incentives, inventory days, and pricing power. Story 5. Competitive pressure in key markets is still building. The hook. Reports out of China's auto sales rankings suggest the Tesla Model Y lost its top spot in 2025, replaced by domestic models. Context. China remains one of Tesla's most strategically important regions for scale, and it's also the most competitive EV market on Earth. Domestic brands are improving fast, and they often have strong local supply chains and aggressive pricing. Details. The reporting points to a shift away from the Model Y's prior leadership position. Even without perfect data granularity in this roundup, the implication is clear. Tesla can't rely on yesterday's hits indefinitely. Impact. Competition can show up in two places: price and mix. If Tesla responds with price cuts, margins compress. If Tesla holds price, volume can slow. Either way, investors will be watching for how Tesla balances share versus profitability. Takeaway. China is where Tesla's manufacturing strength meets the toughest competitive reality. Watch for refresh timing, feature differentiation, and local pricing discipline. Now, a quick lightning round of headline risk around Elon Musk. Multiple outlets report that Musk is seeking a massive damages claim up to roughly $134 billion in his legal fight against OpenAI and Microsoft. This is not a Tesla operating story, but it can influence Tesla through CEO attention, reputational spillover, and general risk perception among institutional investors. And separately, there's ongoing controversy tied to Musk's AI ecosystem, with an Associated Press report describing a lawsuit involving sexually exploitative deepfake images generated by Grok. Again, not Tesla's core business, but these issues can contribute to CEO overhang in the market. Closing recap. Today's big Tesla takeaways are: Tesla's AI-5 self-driving computer update keeps autonomy in focus, but the timeline messaging remains inconsistent. Optimus appears to be moving from demo to internal deployment scale, which could eventually improve manufacturing economics, and U.S. regulatory scrutiny of FSD remains an active overhang. For tomorrow, watch for any follow-on details from Tesla or regulators on the FSD investigation response, and keep an eye on incentive trends. Financing and pricing moves are often the earliest signal of delivery momentum. That's it for today's Tesla Daily News podcast. If this helped you stay on top of the stock-moving Tesla story, subscribe and follow for your daily update.